What's up, everybody? Welcome back to the channel where I teach you how to build cash flowing assets, because we all know at the end of the day, that big number is not what's important when it's time to retire. It's how much money do I have consistently flowing through my hands on a monthly basis to keep my lifestyle exactly where I want it to be. So today we're going to discuss how to design a properly structured participating whole life policy used specifically for infinite banking. I'm going to go over an example for you guys that I think will really help break down and help you better understand infinite banking and the power behind infinite banking, and really allow you the ability to decide if this is going to be the right vehicle to help you build wealth and create that strong foundation. Be sure to stay tuned all the way till the end. I think this video is going to be exactly what some of you need to make that infinite banking bug click in your head and give you the motivation that you need to get your first policy up and off the ground. So let's go ahead and hop into it. So how to design a properly structured policy. Well, first things first, understand that there is a ton of customization that can be done to these policies to help really achieve whatever results that you are looking for. But before we jump into any of that, when designing a whole life policy, it's important to understand that there's some specific terminology that you're going to want to know. The premium is the amount of money that you can contribute on an annual basis. Now, yes, it can be paid monthly, but annually is typically recommended because the overall cost can be reduced, similarly to, auto insurance premiums. And a premium is made up of essentially 3 or 4 different parts depending on the specific client. So number 1, you have the base. Number 2, you have the PUA rider. Number 3, you have the PUA dump in. And number 4, you have term insurance. I'm going to break each one of those down so you guys better understand the terminology that I'm using as I go through and explain this information to you. All right, so let's start with the base. Now, the base is extremely important. This money goes towards buying the death benefit. Typically, it'll be rewarded with the most dividend growth in the long run. However, it adds very little cash value early on to the policy. Now, the base premium is due for the length of the policy and has strong dividends relative to the PUA rider, like I said, and I'll explain that here. But really, in other words, the base is what allows a much stronger cash flow during retirement years, so later in life. But it tends to be not as attractive early on for liquidity purposes. Now, you can design a policy to be as short as 10 years or keep premiums going all the way up to age 121. There's definitely benefits to both options. Now we get on to the PUA rider. This portion of the premium stands for paid up additions, and it allows for more flexibility within the policy. So you can choose to fund this or not, depending on the insurance company. The PUA buys a much smaller portion of the death benefit, just like I mentioned before, and the majority of the money goes towards early cash value. We're talking in the 90% range of the PUA premium is available for immediate use, which is huge. The purpose of this rider is to provide early cash value and make a policy more usable early on compared to just having, a huge base premium. Now, you have the ability to drop this rider whenever you want, but the more you learn about infinite banking, the longer you'll want to keep it on and the more money you'll want to stuff inside your banking system. All right, so next up is the dump in, which is also a PUA rider allowed in the first contract year. This rider will act just like the normal PUA in regards to the amount of liquidity that you'll have access to. So remember, like I said, 90+%, but again, it can only be funded within the first year. This is often a great option if you know that you have an additional large sum of cash that you don't expect to be receiving on an annual basis. This really gives that policy a kickstart so you can have a nice, huge pile of money that you can pull from while it's still working for you in the policy. And last but not least, we have the term rider. So the term rider is extremely important to the policy. Sometimes you need it, sometimes you don't. It all depends on the specific person that's looking to get the policy, age, amount of money, all of those things are going to factor in. But the term rider is put onto the policy to make sure that the policy does not MEC. MEC stands for Modified Endowment Contract. And if your policy MECs, meaning you put too much money into it and it becomes what the government would consider an investment, instead of life insurance, well, then they're going to tax it. They're going to turn it into a taxable asset. So again, your policy turning into a MEC wouldn't be the worst thing in the world. A lot of businesses, very large businesses, are totally fine with that happening. But at the end of the day, if we're using this thing for banking, ideally, we want to avoid that MEC status. Now, putting money in and pulling money out is why I love this asset for entrepreneurs. And at the end of the day, not just entrepreneurs, I love it for most people, especially if you're somebody that's able to save more than you spend. Now, you might have heard of infinite banking being called by many different names, but if you're unfamiliar with the gentleman who first put a name to the 200-plus-year-old concept, I highly suggest heading on over to Amazon and snagging yourself a copy of this book. We in the industry would really consider this the Bible of infinite banking. It's called Becoming Your Own Banker by R. Nelson Nash, and it's definitely where I suggest that everybody start. It's a damn good read, and it's a great way to truly begin to understand this incredible concept on a level that I think most people are pretty capable of. So let's use simple numbers so that you can understand the options that you have. I'm going to show you this cylinder here, which is going to represent the premium and its components of a policy. So let's just start with $10,000. So the base will have, like I mentioned, little to no cash value early on. So we can add the PUA rider on top of that. We typically can do 3 times the base premium into the PUA rider. So in this example, we can fund this policy with an additional $30,000. So the PUA rider can be funded or not, just like I mentioned before, and the policy will remain in force, meaning it does not need the PUA rider on it to continue on as a policy. Now, the PUA rider is what really allows a great deal of the flexibility throughout the contract. If you decided you didn't want to put the PUA in 1 year, for example, that $30,000 or ever again, then you can totally do that. Your policy will still remain intact, and it'll still have those guarantees growing for you. Now, this is very important to note and is a common misconception that these premiums are not flexible and have to be paid for the rest of your life or your whole life. And that's simply not the case. You can pay that $30,000 if you want. You don't have to. You can pay a portion of that $30,000. It's completely up to you. Now, in the first year, you're also allowed to do the dump in, which doesn't necessarily have to happen all at once, but should take place in the first year. And again, that kind of depends on which company you're going with. That's a conversation that we can have if it's something that you're interested in doing. But the dump in, like I mentioned, acts just like the PUA. About 90% shows up as available cash value immediately, depending on the age, the carrier, and the health of the specific client. But in this example, I'm showing a one-time dump in of 6 times the base. This makes the policy extremely attractive and is an easy way to really start to replace your typical banking system in your life. So with all this extra cash going into the PUA riders, we need to add a little bit of term insurance to bump up the death benefit and prevent that MEC status, like I mentioned before, because if we're trying to start our own bank, we don't want this thing to be taxable. Now, the term insurance premium will be determined by the insurance company. They'll figure out how much it needs to be to prevent that MEC status. So you, as a consumer, you don't have to worry anything about that. It's all technicalities here. This is why the premium amount is typically unusual if you're dealing with a policy that requires a term rider, which I tried to illustrate here. You're seeing this $1,572. It's not just like a round 0-digit number, but this is an example, and I want to stress to everybody that everyone's situation is unique, which means for your design, maybe you require the term, maybe you don't. It all depends. But if somebody wants to put in less than this, because you may be adding these numbers up, you're like 10,000, 30,000, 60,000, 1,572. Shawn, we're talking about over $100,000 here. What if I can't do $100,000? If you want to put in less, you can put in less. It's totally up to you. This thing works on a bunch of different levels. This is just an example. So again, on the flip side, if you want to put in more cash, you can definitely do that as well. I've worked with several high net worth clients who put in large sums of money into life insurance on an annual basis. I put in a large amount on an annual basis, but that's only because they were highly successful, they had a high net worth, and they want to keep control of their money without relying on the typical banking industry. They wanted liquidity, they wanted guarantees, they wanted all the things that come with these type of policies. So if you're curious about how much you need to start a policy, book a free cash consultation. We can walk through your specific numbers. Okay, so this policy design example is intended to provide high early cash value and to be minimally funded long-term. So like I said, everybody kind of comes into this wanting something different. Some people want to design policies to help supplement income in retirement years, in which case the base and the PUA ratio would likely be adjusted. For example, sometimes it makes sense to allocate 50% into the base and 50% into the PUA, or allocate it almost all into the base with just an extra dump in during the first year to really kickstart the policy and maximize the cash flow it can produce for you. It's really up to your situation. These things are, like I mentioned, super flexible and they can fit exactly what you're looking for. So I think we should hop into an example and see what a real illustration looks like. Okay, let's go over a real life example here. So remember, insurance is based on age, sex, and health. And the most common question I get is, Shawn, what's the catch? It's simple. You have to qualify. So in this example, let's take a 40-year-old man who wants to retire at age 65. This policy is going to be used for banking purposes, so putting money in and pulling money out in the most effective way possible. So for this person, this gentleman, Mr. YouTube viewer, age 40 years old, we designed the policy exactly as I explained in the last section. Same numbers, same everything. I'm assuming that this person has never studied or maybe even heard of the infinite banking concept before. They've probably followed the traditional route of saving for retirement and purchasing things like cars or saving money for their kids to go to college, if their kids go to college. So they probably have some money in the bank. They've got money in a qualified retirement account, and they have a decent income. Now, in this example, we're going to put $10,000 into the base of the policy and 3 times that amount into the PUA. Don't mind a couple pennies missing here and there. It's just something that the illustration does, but same numbers as before, 10K into the base, 30K into the PUA. Now, the base of the contract, as I mentioned, goes to buy a big death benefit. It also gets recognized by the insurance company as being very profitable to them, and they will reward the consumer in the future, which I'll explain in a minute. But believe me, you should enjoy having a strong base for the contract, as it allows for a lot of future growth and is rewarded very nicely with dividends in the long term from the insurance company. So again, the PUAs go mostly into the cash value, and they buy just a little bit of the death benefit here. Just like I mentioned before, in this example, we're also going to maximize the dump in. So in total, we have 10,000 going into the base. We have 30,000 going into the paid up additions. We have $60,000 going into the dump in, which means the first year cash value should be around $80,000 to $85,000. You might have heard in the past that life insurance is expensive or that there are high commissions and fees. I guess that depends who you're working with and what kind of policy you're getting. I guess that could be true, but that's not the case here. How you structure the policy affects how much commission goes to the agent and how much cash value you can get access to early on. So in this scenario, what you've done is you've essentially created yourself a nice, solid foundation to start banking with. Again, whether you start big or small, starting somewhere is really what's important. Oh, and I forgot to mention, you're going to have to add that $1,572 on a year, $1,572 a year, to allow you to dump that $60,000 into the policy. So now that I've created my own bank, what's next? Well, once you put your money into your policy, you can literally call up the insurance company 2 or 3 weeks later and say, hey, I want to pull some money back out. And in this scenario, in the first year, up to 80% of what you put in is going to be available to you to pull right back out. Let's take a look. All right, so when designing a policy, you get to determine how much cash value it has versus long-term growth. In my eyes, I like a good balance, but follow me on this. When you set the value, that becomes your annual premium moving forward. Now, with this type of policy, because you did that dump in, you can no longer add that $60,000 extra again. But in the first year, if we put $100,000 in cash into the policy, plus the term rider, the cash value is over $87,000. You can see it circled. After that, you put in only $40,000 per year plus the term rider. Now remember, you don't have to put in the PUA on an annual basis. That's that $30,000. Technically, all you really need to pay is just a base amount annually. And the insurance companies we use allow you to fully or partially fund the PUA rider in any year following. So if you don't want to come to the table with the entire $30K, you just have to put up $120 for the year, basically $10 a month, and you can go back to fully funding the PUA the next year. Or maybe you can only fit in $5,000, $6,000 that year, depending on your budget or how things are going. You have that flexibility. That's what that's there for. Now, when starting the policy, this begs the question, does the PUA rider need to be funded immediately, or can it be funded throughout the year? The answer is usually. Some insurance companies do allow you to fund the PUA rider throughout the year, which allows for a bit more flexibility. Some, specifically first year, required it up front. It really depends on the situation. But money in the base earns more dividends than the PUA. The trade-off is that long-term growth might not exactly be there if you're focused all on the PUAs. And if you're getting into banking, a lot of us like to think long term. So typically what I like to see is around a 60% PUA, 40% base, get a good even balance of longevity and access to liquidity. This will really give you a good amount of that upfront cash from the PUAs and a base that will give you that long-term dividend growth, which will help you get set up for your retirement years when you start having that money printing machine. All right, now let's return to our example of that healthy 40-year-old man. So we're putting $10,000 into the base, which has smaller early cash value, but larger long-term growth. We're putting $30,000 into the PUA rider, which has early cash value, but smaller long-term growth. And then we're gonna do that first year dump into the PUA of $60,000. And finally, we're gonna add the $1,572 of term insurance. Now remember, the reason for that is we need to pump up the death benefit to avoid that MEC. So the term insurance is a rider that can be dropped in the future, but it temporarily makes the death benefit larger so that the IRS doesn't consider it a MEC and still considers it life insurance, not an investment, just like I mentioned before. Now, if you take a look here in the first year, you'll see a premium of $101,572. I'm gonna round up 4 cents here, and a death benefit for this 40-year-old of about $2.3 million. Now, that's tax-free. Now, the cash value is around $87,000 to $88,000. And the policy owner can borrow up to about 96% of that amount. So like I said, a little more than 80% is available for immediate distribution of whatever you want to go take that money and do with. Now, in years 2, 3, and 4, the consumer puts that $40,000 along with the extra term cost in to keep that death benefit higher. So no more 60K, we're just doing the 10,000 base, 30,000 PUA plus the cost of the term rider. Now do me a favor here, look at the cash value growth between years 1 and 2. Mr. YouTube viewer put in around $40,000 and it's growing by around $40,000. Just do some quick math here. You do year 2 minus year 1. That's 127,585 minus 87,838, which means when he put in that 40, again, we're not including the term. You can include the term if you want, but when he put in that $40,000 of base in PUA, his policy grew by just a hair under $40,000, which is great. This is what I mean when I say that the policy will replace your bank account, and it can happen really quickly. The reason you want to do this is that you can then leverage that cash value over and over again, and the policy will continue to grow for you in the background. Now, next thing I want you to look at is take a look at year 11. I got it, the red underline right here. We've gotten rid of the term rider and the PUA rider. I want you to note that the death benefit has also dropped though. So now instead of 3+ million, it's 1.6 million because the term rider is gone. So Mr. YouTube viewer can decide to keep the term rider in force to maximize the death benefit for his family. Or maybe he decides, hey, I'm 50, I'm super healthy, and I'm still trying to maximize the cash value of my policy. It might make sense to drop off this term rider right now. Completely up to him. So in this example, we dropped the term rider after year 10. You can see we also dropped off that PUA. So now the only money that's going into the contract is that $10,000 of base premium every year. So I want you guys to take a close look at something here. What happens to the cash value in year 11 after the PUA drops off? And we're now only putting in that $10,000 of base. It goes from $514,684 to $543,403. That's a $28,719 growth. So your deposit of $10,000 gets almost 187% cash on cash return just by going into your policy, AKA your banking system. And that continues to get bigger each and every year. So just to make sure you guys see this math, you're taking 543,403, you're minusing it by the previous year. That's how much you have. You take that number, you subtract 10,000. That gives you the amount of net that it grew. You take that number, you divide it by 10,000, and that gives you 1.8719. You move the decimal place 2 times, you had 187.19% cash on cash growth. You got yourself a money making machine here. Now think about this. Let's say that you had that $10,000 and you put that $10,000 into your bank account. Let's call it Chase Bank. What happens when you put that $10,000 in? Now you could maybe get $10,000 out. I don't know if they're going to give you their full 10,000, but you put 10 in, you get 10 out. Maybe they give you a few pennies of interest, maybe. However, When you fund the policy that year with $10,000, it turns into almost $29,000 of cash value overnight. This is the true power of compounding with zero risk of loss. Pretty incredible. I don't know about you guys, but I would ask you which scenario you think is the better scenario. Put 10 in, get 10 out, put 10 in, get almost 29,000 out. I'm going to go with option number 2. And I think you guys are too. Now, in this contract, the premium stops at age 65. So you'll notice that at age 66, there is $0 going into the annual premium column. Contractually, the insurance company cannot come back to you and say, hey, Mr. YouTube viewer, you owe more money for this death benefit. It's one of the guarantees of whole life. The contract is paid for. It's called paid up, which means the death benefits are guaranteed and continue to grow. The cash values are guaranteed and continue to grow, and the premiums are guaranteed to stop. Now, at this point, in this example, there's just over $1 million in cash value. At age 66, there's no money going in, and the policy is still growing by almost $45,000 a year. And that's, again, just getting bigger and bigger every year. This can become a supplemental retirement cash flow stream if Mr. YouTube viewer wants it to be, one that does not trigger any taxation. Can I get a hallelujah? However, this policy is funded with early cash value because Mr. YouTube viewer wants to use the cash before retirement, which we highly suggest you do as well. So let's take a look at year 10 here. The cash value in year 10 is $514,684. Let's say that in year 7, you're still funding the policy and you say, hey, honey, let's do something fun together and put some quality strain on our marriage. Let's go flip a house. You tell her, we have all this cash value. Why don't we use it? So you call the insurance company and you say, hey, I'd like to put some strain on my marriage. I want to take a loan for $200,000 against the cash value of my policy, and I'm going to go flip a home. You don't have to tell them that you're flipping a home. All they're going to say is, great. There's no long application process. There's no credit check. There's no credit reporting. There's no 1099 to receive the money. There are no questions about what you want to use the money for, even though you told them. Doesn't really matter. There's no repayment schedule on this loan, and it won't affect your ability to get a loan at the bank if you want to go and get a separate loan. All they're going to ask you is 2 things, Mr. YouTube viewer. Where do you want the money sent? And can you confirm your identity, please? And you're going to say, hell yeah, I can. Send me that $200K, please. Now, in this image, I'm showing you a $200,000 loan being taken out in year 8, plus the interest that you would have accrued that year that you're not going to be paying back just yet. This $200K can be the down payment for the property. And since there is no one coming to break your legs if you miss that repayment, like maybe would happen with your credit card, maybe they're not breaking your legs, but they're charging you out the wazoo. You don't need to make any monthly payments back to the loan until you're ready because you've got your own banking policy and you got flexibility. Now, of course, you will be accruing interest, which is shown there by the additional $10,659 on the back of that $200K, but there's no set repayment. So you pay when you can pay, sir. Now, let's assume the following year that you still haven't sold the property that you flipped, and maybe you're still together with your spouse. You guys made it through the strenuous times of flipping the home, but now you're looking to try and sell it. And you haven't sold it yet, and you don't want to make the yearly premium payment of your $41,571.96 that it takes to keep your policy going. But you want to make sure that you're still paying the PUA. So instead, you take a loan from your cash value, again, to pay that full $41,571, knowing that you'll be able to put all that money back in as soon as you sell the property. So you'll see that nothing is going into the premium. Again, forget that 4 cents. I told you sometimes they're a little funny with how they illustrate these, but nothing is going into the premium column for year 9, which means no cash came out of your pocket, not even the interest on the $200,000 loan that you had taken, because remember, you can pay that off when you're ready, sir. So notice how that death benefit actually went down a little bit in year 8. You might be asking yourself, why is that, Shawn? Why does the death benefit decrease a little bit right here? Well, that's because you borrowed against your heirs' future benefit. If you borrowed $200,000 in year 8 and you pass away, your family would get whatever you did with the $200,000, so that property that you flipped, and they'd get $2.8 million as a tax-free death benefit. I don't know about you, but that sounds like a pretty good deal to me. I think your wife would be all right with that. I think she'd forgive you for flipping that house, hopefully. Now, let's say in year 10, you came into a windfall of cash. Maybe you finally sold the flip, or you just inherited some amazing lakefront house in Vermont that's been in your family for years. But let's say that you sold the flip and you have a little over $307,000 in profit from that. You crushed it. So you're like, what am I going to do with this money? Well, you're a smart banker. So you put that $307,000 back into the policy, as you can see listed here. It repays the loan, the interest that occurred, and the premiums that you didn't pay from year 9. So boom, we're good to go. Now, how much cash value do we have in the policy? Look at the column for year 10 here, $514,684. Now, look at the column for year 10 and the cash value when you didn't take any money out. So this is policy without the loan. What's that number? 514,684. Are these two numbers kind of the same, or are they exactly the same? Yeah, they're exactly the same. Why? Because when borrowing against my policy, I'm borrowing money from the insurance company with my policy being used as the collateral. I'm technically borrowing against my policy, not from it. Yes, I'll pay them an interest rate. You would pay anybody an interest rate, but my money has been sitting in my account, growing, compounding interest this entire time. Life insurance is the only asset that I know of where the underlying collateral asset is guaranteed to grow. If I were to borrow against my home, its value could go down. Life insurance, that's not the case. I think real estate can provide a nice comparison of how policies work. In real estate, you have a few different terms that most people are familiar with. Market value, how much could I sell the property for? While the market value can fluctuate, historically, homes values tend to go higher over time, with a few dips as exceptions, of course. When I die, my family typically gets the property and its full value with a step up in basis and no taxes due on any gain. Debt, the amount mortgaged to buy the property. And then equity, the perceived difference between the market value and the amount of debt owed. The unique thing about equity in a home is that, well, it's not yours. If you want proof, go ahead, try and take it out. You either need to sell the property or get a line of credit from a third-party lender, which requires approval with income verification and all sorts of red tape. Trust me, I'm going through the HELOC process right now because I'm pairing infinite banking and a first lien HELOC together, which we can talk about another time. Now, life insurance is very similar. The jargon is just a little bit different. You got the death benefit, the amount of money my beneficiaries receive when I die, income tax free, the amount at risk, which is the difference between the cash value of the policy and the death benefit. It's really the amount at risk to the insurance company, the cash surrender value, which is the amount of money I would keep if I surrendered my policy, and 96% of which I can borrow at any time without repayment. Cash value acts like equity in real estate, except without all the red tape and the access. And of course, this is guaranteed to grow, and that's not. Think of it like this. When I borrow against a life insurance policy's cash value, I'm using my death benefit, like the market value of real estate, as collateral. And the amount available is the cash value, like the equity in my real estate. So just like real estate, the life insurance policy will continue to grow even when the loan is outstanding. The difference is that life insurance is guaranteed to grow, unlike real estate. Here's something I want you guys to consider. When looking into starting a participating whole life policy you plan to use for infinite banking, make sure to clarify if the dividend is direct recognition or non-direct recognition. Some companies pay dividends that directly recognize an outstanding loan, which is direct recognition, which means the dividend amount credited is going to be affected by the loan being out. Personally, I like to use non-direct companies so I can be sure that my policy will continue to grow even when loans are outstanding. Now, I've heard cases for both policy types, but make sure you do your own research and find out what fits your needs best. I prefer non-direct recognition because by not recognizing the loan, I know that the policy will continue to do exactly what it's supposed to do when I put the money back into the policy. The death benefit is restored to its original amount, and the cash value is brought back to exactly where it should be, just like you saw in the example that I showed. So this allows me to have a rule for investing in the cash flowing assets. If my policy loan rate is around 5% to borrow, as long as my outside investment can earn me more than 5%, it makes sense to deploy that cash value to get that outside investment. By doing this, I've created maximum efficiency. $1 going into the policy buys me a death benefit for my family, guaranteed growth with strong historical dividend growth, and leverage to invest in an outside investment where I can create cash flow to hopefully get more tax incentives. So as this policy gets older and maybe for some reason you're not bringing in as much cash, which shouldn't be the plan, but if it was the case, you could just lower your premium to that base amount, that $10,000, as you'll see we do from year 11 on. At this point, what you've done is you've created yourself a fully sustainable family bank, meaning you put money in and it's guaranteed to grow by multiple times the amount that you deposited. It means that you can leverage this banking asset over and over again before retirement, paying no tax on the growth, no tax on the access, and no repayment requirements. So without question, you can use that money how you see fit. And that, my friends, that's called control. The caveat to all of this is that numbers in this example are net, meaning they are real to you. When you look at a SEP IRA or a traditional pre-tax IRA, the account value is a gross number. It's pre-tax. If you were to pull that money out, taxes would be due. An easy way to remember that is to think about how gross it is that that large number that you see in your account isn't actually yours. With life insurance, the income that you have in retirement won't be affected at all, even though you've leveraged your account over and over again before your retirement years to help you finance the things of your life and build more wealth. This is starting to sound pretty genius, right? Now, imagine funding a life insurance policy and then leveraging it to buy that house on the lake that you've always been dreaming of, to enjoy with the family and to rent out, creating tax incentives and this little thing that's often overlooked in financial planning called peace of mind. Let's just call it joy. There's a rate of return on happiness, and I absolutely plan on teaching my family how to enjoy strategies, not just put them on a piece of paper. At the end of the day, the takeaway is that money in motion is going to help you build wealth. You need to keep your money in motion and never let it be stagnant, just like the banks do with their money. You see, Robert Kiyosaki, author of Rich Dad, Poor Dad, says that savers are losers. They lose due to taxation, inflation, and volatility. When you get your money in motion and buy assets that pay you, you're rewarded by the government and the IRS through tax deductions. Theoretically, if you use a life insurance policy, you're paying for it with your dead self. You can essentially replace the bank with your properly structured whole life policy from a mutual company to fund your investments and lifestyle while still leaving a legacy to your family. And that's what we want to teach you how to do. So before we wrap this up, I want to share two of my favorite quotes that I hope resonate with you as much as they do with me. Number one is, the problem in America isn't so much what people know, it's what they think they know that just ain't so. That's by Will Rogers. And the second quote, I actually didn't like this quote when I first heard it, but it really started to grow on me because of how real it is. If poor people would just do what rich people do, they wouldn't be poor anymore. My suggestion to you is start studying what rich people are doing. Start taking note of what wealthy people are doing. There's tons of resources, books, everything that you need to know to grow your financial literacy. That's how I was able to take myself and my family from a point where, sure, we were doing all right, we were average, and now in this past year, 2024, we put over $100,000 just into our own banking system to get that money working and growing for us for the rest of our lives, and then taking that money and sending it out to make us more money through cash flowing assets. If you want to learn how to do these things, how to take advantage of all these opportunities that are there for you, that maybe you've just never been taught about, that maybe you're learning about right now, or maybe that you've just seen for the first time, let's get you educated. Let's get you reading the books. You see this little book right here, Becoming Your Own Banker? That is an instant classic when it comes to infinite banking. That is the Bible, and we need to get you educated so that you can feel comfortable taking the next steps to becoming your own banker. So if you're interested in having a cash conversation, head on down to the comment section, comment the word bank, and you and I will get on the phone and we'll discuss what your situation looks like, what your goals are, and if infinite banking is going to be the vehicle that helps you build a foundation for the rest of your life. If you haven't already, be sure to head on over and subscribe, smash that bell so you get notified every time I put out new content. 2025 is going to be a huge year for me. I'm planning on educating as many people as I can about not just infinite banking, but ways to create passive income, ways to cash flow their lifestyle. And if you want to join me on that journey, then let's connect. As always, the information is free, but the knowledge is priceless. Until next time, peace, y'all.